Hi folks, how you doing today? Scott Cohen here. We're going to take a look at a tax return problem from chapter 14. So you have a similar problem for homework, and I want to make a video, and I'm going to have that class on Thursday to go over some of these things with you. So for those of you that are online, hopefully walking through this will help you be able to figure it out. Same question, just different numbers. Okay? So let's take a look. Okay? There we go. All right. So when you go to do these, again, I personally find it easier to print this information out than try to scroll up and down and connect. But anyway, tomorrow, okay, she has a condominium and she has some expenses that she has in connection. She's got a condo, okay? All right. And so she's got insurance expense, advertising, mortgage interest, property taxes, some repairs and maintenance, utilities, and then depreciation. Okay, so that's the basic information right there. Now notice it says she rented out the condo for 75 days and she got basically $10,000. This is rental income, okay, from the rental. All right, let's see if I can. All right, rental income. And she used the property for 35 days on vacation, okay? And it says here, let's see this last piece. It says here, tomorrow's itemized deductions for non-rental taxes is less than $10,000 by more than the property taxes allocated to the rental use property, okay? So now they ask us to calculate some things. So notice the first thing you have to notice here, there's two different methods. One is this tax court method, and the other was the IRS method. And notice they tell you to use the IRS method. Now the only differential, notice, this and this compared to this and this. The only difference here is between these two, okay? So you just have to make sure you can use either method. Now, which method does a client typically use? Whichever one's more beneficial to them, okay? So there's two different methods, all right? So now they want us to allocate those expenses. And these are the items they want us to do. They want to know what's the total amount for AGI rental deductions related to the condo. What's the total amount of itemized deductions that she could take itemized. What's the basis in it? Assume that the gross revenue was $2,100 rather than $10,000, and then it wants some answers, and then again $2,100. Okay, so basically they want you to solve it with $10,000, and they want you to solve it with $2,100. Okay, all right. So let's take a look. The first one, it says for A, what's the total amount of 4 AGI rental deductions? Notice it says it has significant rental use category. So this is a classification that you'll find in the chapter based on the number of days. Basically number of days. Okay? So it's significant use. All right? Scroll down a little bit farther. So the first calculation for advertising expense. Now they have different tiers of expenses. And again, this is in the chapter. So for gross rental income, this is how much she took in, $10,000, right? Then her advertising expense is $520. Now mortgage interest, notice 75 divided by 110. This is 75 rental divided by 110, which is personal and rental. And notice that's used in all the calculations, okay? So with these two, mortgage interest turns out to be $2,482, and property taxes $626. So the total tier 1 expenses are $3,628, leaves you a balance of $6,372, and you subtract these in the order of the tier. Okay. Now, same thing for insurance. repairs and maintenance, and utilities. So take a look at what they're doing here. They're basically putting the correct proportion to the rental. So some of this is rental, some of this is personal. So what's happening here is they want to know how much of this belongs to the rental. Okay? When you add up these three items right here, you wind up with $1,827, and now your balance is $4,545. Now the final one is depreciation. Okay, so depreciation, and again they gave us this number of $8,900, right? Well, when you take a percentage of that, times this number, you get this, but you're limited to the amount you can take right now. So you can take $4,545, right? So the total for AGI deductions is the full $10,000, and this additional $1,523 carries over to the next year. Okay, so you'll get to use it, but in the next year. All right, so that's A. Okay, now they want you to know what's the personal. They want to know what's the personal use portion. Okay, what's the personal use portion of interest and property taxes? So this was the amount. This was the amount based upon what you could deduct for the rental business. Now what about personal use? Okay, so we're going to go over here now. Personal use, 35%, 35 days divided by the 110 times the mortgage interest gives you this amount. So these are personal deductions, and 35 again by 110 times 918, 282. So these are from AGI deductions for her, but this is personal. Okay, not having to do with the business. This is her end, so she gets to take all of it. Basically, 75 out of 110 for the renting out, and the other 35 personally. Okay. Now the depreciation. The depreciation. Did they tell you how much this thing was up here? Yeah, they told you the basis in the condo was $150. They would have had to tell you that. So this was her initial basis. So notice, so for her tax basis, she can only take what's actually deducted. So her new basis is $1,455. Okay. Now the next question had to do with what happens if this was all the money that she took in. Okay. So now we're down to the part where we're taking a look, what if she made less money? So now there are some limitations involved. So notice what they tell you. Tamara's allowed to deduct all of the advertising expense and the portion of the mortgage interest expense and real estate taxes as part of the home. These are not limited to rental revenue. So basically there's a limitation. Oops, what happens here? Okay, try again. Some items, some deductions are limited to revenue. Okay, so notice here it says the loss is not subject to the passive loss rule limitations. Okay, and again, this is passive. Why? Because it's a rental property. And then finally, the last one here, E, it says, what about the advertising and mortgage? Again, are treated as tier 1. Okay, and then the other ones are treated as tier 2 expenses. She's already exceeded the $10,000 overall tax limitation, and thus are subject to other tier 2 expenses limitations. So again, the limitations, you have to look them up. Now, for those of you that are going, wow, this is a bit, it is. But one of the things you got to keep in mind, here you're calculating this manually. To let you know in the software, so while you're learning this, you have to understand the background function of what is going on. But in reality, when you're working in a software, you're going to type in the information, how many days or whatever, and within the software, it knows these rules and applies these rules accordingly. However, you always have to keep in mind that as an accountant or CPA, you know what happens if you fat finger putting a number in there. You have to have enough knowledge in your head to know, hey, that doesn't make any sense. Or be able to go and look up and say, well, what is the actual rule? So yes, it's a little bit much, but there are rules, and all you really need to do is apply the rules. Nobody actually expects you to memorize the rules, because it's impossible to memorize all the rules. Okay? So by the way, these are the answers. Okay? These are the answers right here. And basically, because you have different numbers, you should be able to take what we've done here and then apply them to your particular problem. All right? Now, the second part of this wants you to do a Schedule E and a Schedule A. Okay, so let's go take a look at those. Okay? So the Schedule E, for those of you that don't know, I'm going to gives a Social Security thing here, tells you her address so you can fill it in. Okay? Tamara, taxpayer. Okay? So let's look at the Schedule E. So this is what a Schedule E looks like. Notice what it's for here. Supplemental loss, income and loss. It's for 2023 they show here. Schedule E. It's one of the schedules from the 1040. Now to let you know, in VITA we don't do Schedule E's. If you have a Schedule E, you wind up having to go to an accountant because you have to do all these items here. But notice, name, Social Security number, it's got the address right here, Cocoa Beach, okay? All right. So anyway, we go down here and notice here, rents received. This is basically an income statement for your property. Advertising 520, okay? Commission, whatever, 709. These are all the items. Interest, 2482. Again, these were all apportioned. And this is what the software will wind up doing for you. Other interest, this, and then the depreciation. So we apportion all those items, and when you come down here, we hit this $10,000. And then these items, all you have to do for this, it says total of all amounts reported on line 12 for all properties. That's because you could have more than one. What if you have a bunch of rental properties that have more than one? Okay, so these are just totals for all these. Total. The numbers come right up from above, and there is your Schedule E. Okay, and then if you notice the Schedule E, right, when you get down, I don't think, where does it show here? Notice here, also enter this amount on Schedule 1, line 5. So you see this right here? Schedule 1, for those of you that don't know, this is other income. Okay, so it's saying take this bottom number over here, whatever it turns out to be, and move that over to line 1. And in this case, it's 0. There is no other income because basically what you had took in money. Once you deducted everything, no profit. So basically her revenue and expenses petered out, and she has a bit of a loss carry forward. Okay. All right. Now, the next item here, this is the Schedule A. Now, for those of you that don't know, these are itemized deductions. So again, when you're doing tax returns, you have to make a choice. And the choice is, do I itemize? Or do I take the standard? Okay. Now the software, as you fill it out, either software or virtually any tax software, if you put in all the receipts and everything you have, you could tell it pick the best one. But the reality is the standard deduction depends upon your marital status and sometimes age and a few other things. So the bottom line is you want to get the biggest deduction available to you. Again, it's got her name, it's got her Social Security number. You don't know anything about medical and dental. You have no information here, so it's 0. Taxes you paid, $292. This is her personal. This is the personal portion. And over here, interest you paid. This is the personal. Okay. And then the total down here, you add, let's see, they add these through there. And then you add these two lines up. And again, this is all the info we have. Okay? So I think you should be able to knock this one out. Hopefully with that explanation, it'll be enough. I'm going to save this and post it up with it. But again, one thing to keep in mind, yes, sometimes using these calculations, they can be tedious and they can be difficult. Keep in mind, you're supposed to have a fundamental understanding and the ability to find the rule and apply the rule if need be. And you also have software to assist you with that function. All right, folks, I hope you find that helpful. Talk to you soon. Bye.